In order to be a successful trader, you need to have your mental game together. In fact, it works for sports as well. Football, baseball, basketball, competitive eating. You must have your game plan together. So stick with me through this short video, and I'm going to show you step by step how I put my mental game together on a daily basis. Now, first, it's just like it sounds. You must have enough time to focus and put together your trading plan for the next day. So now I'll tell you about what my game plan consists of. And if you stick to the end, I've got 2 bonus tips for you to help make you more efficient. So number 1, I focus on market direction for the next day. I basically make a prediction or I gauge what the market will do. Now I could base this on earnings. I could base this on the Fed. And if I have nothing to base it on, right? I'm just confused. I'm a new trader like you, let's say. What would I do? I look at the previous day and I say, history tends to repeat itself. So I'll just assume that tomorrow will be a lot like today. Step 2, once I pick out market direction, if I'm bearish, I'm either going to decide if I want to play an ETF like the UVXY or the SPY, or perhaps a stock that might have a little trouble, like a stock like Lam Research that missed earnings today. Or example, how about Carvana, which has been going down, down, down. They just came out with earnings and now they're doing a shelf offering. That will put downward pressure on this. Number 3, also in my game plan, if I decide the markets could be bullish the next day, I'm going to look for stocks that have demand. Now, I hate to say it, but airlines have demand. United Airlines just came out with earnings. They fell right in line with estimates, but they say they're going to be profitable in Q2. There's a bit of a rotation from tech into Dow stocks, rebound stocks. Remember, the Dow was up 300 points today. Tech's troubled. So airline stocks, or you have IBM who just beat. IBM who's working on some AI platform to help McDonald's be more efficient, or a stock like Caterpillar, one of my favorites, mentioning it since $202. I think it broke $235 today. Or another industry that's been beat up, and I've been talking about it for a few days, probably a week, Dow Transports. So I'll look at like CSX, which had earnings. Now, earnings did not wow me, but their profit margin did. Their profit margin per container went up 24%. So I might look for a similar type stock like LPX to run a little, or even JBHT, which I've spoken about a few times. Number 4, I like to look at the previous day's highs and lows because it helps me determine my entry point. If I'm looking at a stock from the previous day, I say, okay, its low is here. I will look to re-enter if it revisits its low. Its low from the previous day was its, or if I'm taking a put position, which is a bearish position, I'll say previous day's high was up here. Let me look to see if it gets up there again, and then I can enter my position. Next, number 5, I've got to have a strategy, meaning I have to understand the trade before I get involved. Is this going to be a scalp, maybe a simple one-day play? If it is, am I looking for 20%, 30%, 40%, or is it a longer term play for me? Am I going to buy out my contract a month or 2 and say to myself, you have more time. You're not looking for an instantaneous return tomorrow. You know, for example, and I'll talk about it, YANG, the Chinese bearish ETF, meaning I think the Chinese market is going to go down. So I want to give myself enough time. Let me bring up that chart for you. So we look at the Yang. Remember, Chinese market was on straight fire. And when it was, the Yang dropped all the way from 43 down to 16. No, it wasn't time. This chart looks like Netflix. You're right. But no, it's not time to jump in yet. Why? Because it showed a little rebound. Then they sold it off further. The Yang went all the way down sub 14 when I started talking about it. Then it's 14. Then it's 15. Then it's 16. You know what happened today? The Yang went up even more. Another 8% today. Look at the 3-month chart. Understand, I said when I made my video a week or 2 ago, it was going to fill a gap to 21 or possibly 22. We're not there yet. We still have $3 to go, which is about another 20%. So again, that's just my strategy because I've been talking about it for a few weeks and I want to give myself enough time to be right. Number 6, money management. I like to use the 25% rule. Let me explain what that means. I take $4,000, I set it aside for a specific option play. I don't use it all at once. I use 25%, which would be $1,000. Now, let's say my option goes down 18%, 2 to 3 days after I purchase it. I say to myself, okay, I'm going to use another $1,000, another 25%, and I'm going to buy the same position at a lower price. That's dollar cost averaging. It works on stocks. It works on options as well, as long as you give yourself enough time. Now, if you want, watch Ask Matt. I think it's episode 37, where I explain how to properly average down on options. And finally, when you have all of that ready to go, you need your mental game there, meaning No work schedule calls, no work meeting, no trip to the doctor and trying to trade. Let's say you're arguing with your kids or your kids are acting out in the morning, or your wife or your ex-wife or your partner is giving you grief or putting stress on you. Although you think you have your game plan ready to trade, your mental game
is probably a little out of whack.
Bonus for all of you that made it this far. I've got 2 extra tips to make you a more efficient trader. Number 1, make sure you give yourself enough time. Now that means instead of going out 2 weeks, go out 4 weeks on the option. Or if you go out 1 month on the option, go out 2 months.
That will alleviate your stress.
Yes, your option will have less of a reaction to the immediate stock price, meaning the stock goes up. And you're correct, instead of options that expire in 2 or 3 days going up 25%, your options might only go up 10%. Now, the good news is, say you're wrong. You give yourself enough time to average down. And that is the key to a winning trading strategy. Number 2, bonus number 2, nibble. Now, some of you remember nibble from other videos I have shot. The nibble basically says the first time you take a position, instead of bidding whatever the contract is, let's say I'm buying a contract for $106. I'm like, I'm going to buy this contract $106. I'll put in my bid. I'm ready to execute. Instead, I say to myself, nibble. If I'm going to pay $106, let me try and get it for $99. So I change it. I put it in for $99 and I hit execute. Now, instead of happening right away, because I'm not paying the ask, or I'm not paying the mid at $1.06, the stock goes down, the ETF goes down, it goes down, the options are worth 90 cents. Guess what happens on the way to 90 cents? My contract for 99 cents gets executed. Then I go on and I sign on a few hours later and the contract's back at $1.06. If I did not nibble, I would be exactly even, or plus or minus 1%. Now, because I nibbled and I got the contracts at $99 each, even though they went as low as 90, which is why we can change around our nibble strategy. You could do 5%, 6%, 10%, whatever you tend to miss entry by when you check your phone, like,
shit, I'm down 22%.
I just bought this. That's what your nibble is. If you're constantly down 12%, you say to yourself, instead of paying $1.06, I'm going to pay 96 cents, 12% off. And if it happens to cross over that threshold and you get the contract, congratulations. Because end of day, when it's back at $1.06, instead of being 1% up or 1% down, you got it. You're up about 6 or 6.5%. And that's what we call a winning strategy. Now, if you like this, I drop knowledge all the time in my videos.